This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Questionable prognosis. Aetna plans to leave most of the public health exchanges it operates in, joining several other big insurers. The question now, is Obamacare in trouble?
Steering the future, how Ford plans to get a self-driving car on the road in just 5 years.
And blowing in the wind. The answer, my friend, is that the nation's first offshore wind farm is taking shape off the coast of Rhode Island, ushering in a new era in alternative energy. Those stories and more tonight on Nightly Business Report for Tuesday, August 16th.
Good evening, everyone, and welcome. Aetna is pulling back. The nation's third largest health insurer is dramatically cutting its participation in healthcare exchanges, leaving consumers in those markets with fewer options. And the company isn't pulling back gradually, but instead, Aetna is doing it all at once. The reason? It's running up big losses in markets where patients are sicker than the company thought they would be. The decision is another blow to President Obama's signature health reform law, and it follows similar moves by two other major insurers. And as Bertha Coombs reports, the move raises a lot of questions about the future of the landmark program.
Aetna says it's cutting its ACA exchange plan offerings by 70% nationally next year because after losing $230 million in the second quarter, that kind of loss is just unsustainable. It's a major about-face for Aetna CEO Mark Bertolini, who just 6 months ago said that he planned to expand on the exchanges. Critics say the timing is curious, coming just after the Department of Justice moved to block Aetna's acquisition of Humana.
Maybe then they were trying to butter up the Department of Justice to approve their merger with Humana. Now, when the government has opposed the merger, they are saying, well, you know, we've got such losses, it's not such a good investment. It's very hard to know what the truth is.
Aetna says the two issues are separate, but the bottom line for hundreds of thousands of ACA exchange plan members is that they're likely to see less choice, likely higher prices next year as three of the nation's largest insurers are pulling back on the exchanges. Aetna will be in just 4 states, Delaware, Iowa, Nebraska, and Virginia, down from 15 this year. Humana will be in 11, down from 15, and United Health in just 3 states. That's down from 34 this year.
These large losses aren't isolated to one insurance company. They are systematic, they're occurring across the country, and we could have upwards of 1,000 counties next year where there's only one health insurance company offering coverage.
In one Arizona county, Aetna, United, and the local Blue Cross plans exit from the exchange there means residents won't have any carrier to choose from next year. Officials say they're trying to find a fix, but it's unclear how they can do it.
We don't exactly know what happens in that instance, given that there is no fallback in the ACA for this occurrence, and this was the problem that the multi-state plans were intended to solve.
And Aetna's departure now means uncertainty for the insurers that are staying on the exchanges next year.
I think we may see some carriers that need to raise rates to accommodate the fact that there's going to be less competition, and potentially that they may be inheriting some higher risk enrollees from some of the issuers that are actually exiting the market.
Analysts say without a fix in Washington to make the exchanges stable and sustainable, it's unclear longer term just how long insurers will hang in and continue to sell ACA plans. Bertha Coombs, Nightly Business Report, New York.
Craig Garthwaite joins us now to talk more about Aetna's decision and what it may mean for you. He's an assistant professor of strategy at Northwestern University's Kellogg School of Management, where he specializes in healthcare. Craig, welcome back. We're glad, as always, to see you. The simple question is this: is the ACA falling apart? And if not, why not?
I don't think you could say it's failing. I think what we're seeing is that we might have to temper our expectations about what we're going to get from these insurance marketplaces. There are insurers that are doing quite well. Centene, Medicaid managed care company, is doing well, but how they're doing it is offering plans that are very similar to the types of things that are currently being offered to Medicaid individuals. So these are going to be very narrow network plans focusing on hospitals that tend to treat a lot of low-income patients. And they seem to be able to make a profit doing that. And that might be the model that we see that can be successful in the current insurance marketplace. But what we're not going to see, or at least I'm worried we're not going to see, is this vibrant marketplace that we were promised, where we all can go there and shop among 6 or 7 different companies to get the best plan for our family.
Can you really call it a marketplace if there's only one player in it and they're not the big players? They are these more narrowly targeted ones?
Well, I mean, I think we should keep in mind that United and Aetna, these companies that are leaving the exchanges, while they're big national players, in any individual marketplace they were in, they had a relatively small market share. The local Blue Cross and Blue Shield are still the dominant players in the insurance marketplaces. So we do have big insurers there. I do think you're right. The idea of what we think with a marketplace is we're going to see lots of different companies and we can pick and get the right plan for us. That might not be what we have unless we can get more customers into the exchange.
What about those sicker patients that, if they were with Aetna, now do not have Aetna as an option? Those other companies might inherit those sicker patients.
Yeah, I think that's a real concern, and we're going to have to see whether the rate increases that were proposed, which were already quite high in sort of the low double-digit figure increases, whether those are going to have to go up even more to accommodate what might be a very sick patient caseload that Aetna had.
So what's the solution here? Is it the so-called public option?
I don't see how a public option solves the fact that we have an inability to get healthy people into the exchange. I think more importantly, we should be looking at solutions that move more people from the employer and large group market and into these marketplaces. Those are the individuals who are going to be relatively healthy, who are going to pick broader network PPO style plans that we're all used to. And so things we can do that move more people into the marketplaces should make them healthier.
Do you think that perhaps the Justice Department stepping in and kind of thwarting the big mergers of earlier this year, do you think that had anything to do with it?
So I saw in your clip that Zeke Emanuel had said that. I find that very hard to believe. These are pretty complex decisions for a company like Aetna to sort of spitefully say, oh, I'm going to leave because you're not granting my merger. They are losing hundreds of millions of dollars, and they've documented that to the market, and they can't lie about that fact. And I think that maybe their business model right now is just not the right model for the exchange. And we have to think about that.
So very quickly, Craig, how do you move those healthy patients out of the employer-based system and into these marketplaces? What's the incentive for them to switch?
Well, one thing we have is right now we have an artificial incentive to keep them in. So the ACA has a penalty for employers that choose to allow their employees to go into the exchange. You know, a lot of people would be better off being in the exchange because when you're there, you get those really big government tax subsidies to purchase insurance that you just don't get from your employer. So at a minimum, we could stop having a mandate that limits the number of people that are going to enter these marketplaces. We're sort of shooting ourselves in the foot with that.
All right, Craig, thank you very much. Craig Garthwaite with Northwestern's Kellogg School of Management.
And healthcare costs are rising for 65-year-olds. A new report from Fidelity shows that a couple retiring this year will need $260,000 to cover those costs in retirement. That is up 6% from last year and 18% from 2 years ago. The estimate applies to those with traditional Medicare coverage and takes into account premiums, co-payments, and prescription drug costs.
On Wall Street, stocks retreated today from record levels set yesterday. New economic data and comments from several Federal Reserve officials kept the lid on any gains. Bill Dudley, the head of the New York Fed, said in an interview that the central bank may raise rates as soon as next month, citing strength in the labor market. Dudley's colleague, Dennis Lockhart of the Atlanta Fed, said the economy is likely strong enough to withstand at least one rate hike this year. Now, those comments weighed on stocks. The Dow Jones Industrial Average fell 84 to 18,552. NASDAQ dipped 34, and the S&P 500 was off 12.
Some say today's read on inflation works against a September rate hike. The Consumer Price Index, which reflects the prices that consumers pay for goods and services, was unchanged last month, primarily because of a sharp drop in the price of gasoline and groceries. Fed policymakers have been looking for firmer inflation readings.
Home builders broke ground on more properties than expected in July, climbing to a 5-month high. Housing starts up a little more than 2% last month as building activity increased across the board. But according to the Commerce Department, permits for future construction dipped slightly.
And the rebound in housing has indeed been very good to Home Depot. The Dow component raised its profit forecast for the year after reporting record earnings and sales for the most recent quarter. The company says big-ticket items are driving sales, as are purchases from its professional customers, like plumbers and electricians. Shares, however, fell in trading today, along with the broader market.
From one Dow component to another, Apple, which is pledging to invest more in China. But the world's second largest economy is proving a tough market to crack for the world's most valuable company. Eunice Yoon reports tonight from Beijing.
Tim Cook has made an unannounced visit to China. The company wasn't forthcoming with the details of his schedule, but he has been active on his Chinese social media account, and by that we could get a sense of what he's up to. He started his trip by meeting a local fashion designer who said that she sketched on the iPad Pro. He visited a fitness gym to see sports fans incorporating Apple Watches and other devices as part of their exercise regimen. And he went to a model home where app developers demonstrated some of their ideas for the home of the future. Based on those photos, he seems to be promoting Apple's latest products to create more buzz about the products in China. But he also spent the morning with app developers, talking a lot about how excited he was about the iOS 10 system and encouraging them to create more apps for Apple products. This could be key for Apple because there has been concern about the company's relationship with the Chinese government and what that could mean for Apple's future. Regulators had shut down some of Apple's services. But entrenching the company through its popularity of products as well as the apps could bolster Apple's position here, no matter the relationship with the state. Cook also spoke with some local journalists who asked him questions about sagging sales for the iPhone, as well as the growing competition in China. He acknowledged that the environment here was more competitive, but at the same time, he said that he's looking forward to the fall. And of course, that's when the iPhone 7 is expected to be released. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Small cap stocks are on a roll after a slow start to the year. Small cap stocks are adding gains to the Russell 2000 and catching up to their larger counterparts. The benchmark for small cap stocks is up 8% so far this year. But can the run up in small caps last? Joining us is Chris Retzler, top performing portfolio manager of the Needham Small Cap Growth Fund, which is up 16% so far this year. Welcome. Nice to have you here, Chris.
Thanks for having me.
And congratulations on the performance. Why do you think that you're bullish for the rest of the year on the small caps? What's the background to that?
Well, we think global interest rates will continue to remain low across the interest rate curve. The central banks are continuing to be accommodative, which is pushing investors out on the risk curve. And so what we've seen since February is a recovery in small caps, which really followed the recovery in the high yield markets, which sank quite hard last year with the energy decline. So on a relative basis, small caps are compared to high yield bonds many times. And so as we see that strength, we think that the small cap rally can continue. It certainly had a good run this summer. What we're seeing more of is a nicer, better volume this summer than we've seen in the past years. And I think that gives people more confidence to get into the small cap area, where in past years the volume has been very light, and so sometimes it could be trapped in those names.
You know, Chris, our viewers sit there and they hear 8% for the Russell 2000. This guy is up double that, or they want to know what your secret sauce is, Chris. Tell us what stocks have powered your portfolio to that. Where have you been concentrating?
Well, first and foremost, we concentrate on good management teams. We focus in the growth areas, so technology's been very good. Healthcare has also been good for us. But in technology, what we've seen is a return of the M&A activity. And so larger companies are looking into the smaller cap companies to buy growth, where at a reasonable valuation, they can buy in and then take that on a much broader basis.
Talk about your 3 stock picks that you gave us. You say you're excited about Ultra Clean Technologies.
So Ultra Clean Technologies is exposed to the semi-cap equipment sector, which has been doing very nicely after Intel's delay of its 10 nanometer rollout last year. Those dollars are being spent here in the second half, and Ultra Clean benefits by being a supplier into that supply chain.
Your last 2 are Amber Road and PDF Solutions. Give me thumbnails on those, but also tell me, you mentioned that M&A activity is a big part of some of the growth there. Do you go looking for companies that could be takeover targets, or do they just happen?
They mostly just happen. It's a very hard way to invest, to just do M&A. but we are the beneficiaries of long-term investment where these targets do ultimately get taken out. Now, Amber Road was a broken IPO last year. It had to redo some of its customers. But when you look at its business, it's beginning to add customers. And what it does is it solves solutions in the cloud for global customers, so around trade. And so things like Brexit and other treaties out there for trade, Amber Road really benefits and helps its customers navigate those changes. So we think there's a big opportunity.
And PDF Solutions, PDFS.
Yep, it's another great company that solves problems for semiconductor companies, which helps to improve its yield manufacturing. And yield is quintessential in getting the highest profits within the foundries. And so they are helping, as Intel's rolling out, companies like that to drive higher yields.
Chris, congratulations on the performance. Thanks for joining us.
Thank you for having me.
Chris Retzler with the Needham Small Cap Growth Fund.
And still ahead, big plunge, the troubling news that took one stock down 26% today.
Ford is doubling down on self-driving cars. The automaker has plans to sell a fully autonomous vehicle in just 5 years. But will that move ease concerns that Ford was losing the race to build the car of the future? Phil LeBeau has our story.
Ford is steering toward a future where increasingly it's the vehicles, not the people behind the wheel, that will actually do the steering. In fact, the automaker now expects to build a self-driving vehicle by 2021. Ford won't say exactly what the vehicle will look like, but it won't have a steering wheel or pedals. And Ford says it will be a commercial model being driven by rideshare companies. It's part of CEO Mark Field's push to transform the automaker into a mobility company, driven by technology and new ways to look at cars and trucks.
We view the next decade as really being defined by the automation of the vehicle. So our view is autonomous vehicles could have just as much significant impact on society as Ford's moving assembly line did 100 years ago.
But unlike 100 years ago, when Henry Ford moved faster than the rest of the auto industry, Ford finds itself fighting the perception that other companies like Tesla and Google are the ones leading the push for self-driving cars. Field says that impression is wrong.
We've taken our time to talk about our autonomous vehicle plans because we're not in a race to make announcements, but we are in a race to do the right thing for our customers and our business.
That could include Ford getting into ride-sharing, an industry dominated in the U.S. by Uber and Lyft. Ford is running a rideshare pilot program in England, and its expanded R&D center in Palo Alto is looking at other technologies transforming how we get around. In fact, Ford has announced new investments or partnerships with 4 companies that specialize in technology for self-driving vehicles. Ford CEO Mark Fields is adamant the company will be ready when drivers eventually take their hands off the wheel. For Nightly Business Report, I'm Phil LeBeau in Chicago.
And to read more about Ford's push into self-driving cars, head to our website, nbr.com.
Hain Celestial delays its results, and that is where we begin tonight's market focus. The maker of organic food said accounting issues prevented the company from reporting this year's results and that they will not be released until a review of the company's financial practices is completed. In addition, Hain also said it will likely miss its previously announced yearly guidance. Shares fell 26% on that unsettling news to $39.35. Weak commodity prices and the impact from a deadly mine disaster in Brazil caused BHP Billiton to post a more than $6 billion quarterly loss. The mining firm also reported a decline in revenue and said it would slash its dividend 77% to 14 cents a share. Shares were up 30 cents nonetheless to $31.50. And profit and revenue rise at Dick's Sporting Goods, topping expectations. The athletic gear and apparel company said there was less of an impact from the liquidation of rival Sports Authority than Dick's initially anticipated. The better-than-expected results also prompted the company to lift its full-year guidance. Shares for the day up 7% at $58.76.
Robust foot traffic lifted results at TJX, helping the owner of discount stores TJ Maxx and Marshalls to top estimates. And those results prompted the company to raise its forecast for the year. But shares initially fell on weaker than expected guidance for this quarter. TJX shares were down more than 5.5% to $77.97. Activist hedge fund ValueAct took a 2% stake in Morgan Stanley for about $1 billion. The hedge fund, which has in the past called for change at other companies, isn't yet attempting to do that at Morgan Stanley. Instead, ValueAct said it is very supportive of the bank's CEO, James Gorman. Shares rose nearly 2% to $30.25.
An historic moment for Lower Manhattan. The World Trade Center Mall reopened today. The developers hope the shopping center will be a symbol of the progress made in revitalizing the area in the 15 years since the September 11 attacks. Courtney Reagan is there for us.
For mall operator Westfield, it's been more than 15 years coming. In July 2001, the mall operator signed a lease to begin expansion of the World Trade Center Mall in downtown New York City. 6 weeks later, the world changed on September 11th. But today, after a flag-raising ceremony outside the Oculus centerpiece of the mall, Westfield World Trade Center opened for business. Westfield's co-CEO, Stephen Lowy, says professionally it's a proud day, while personally it's an emotional one. Thousands of family members and friends of those who died on September 11th are here.
We're very respectful for what took place on this site. It'll be forever remembered. But what's really important is also the resurrection of the site. This is now a place of culture, community and commerce. For Westfield, it's particularly significant because we're opening what we believe is now a global flagship, setting a new global benchmarks with retailers and consumers and how they interact with one another in one of the most magnificent buildings on the planet.
There's 350,000 square feet of retail space housing 100 brands, including Apple, Kate Spade, Under Armour, Banana Republic, Sephora, and H&M. Plus famed chef Mario Batali's Eataly food marketplace. Not every brand is ready to open its doors today, but Westfield says the mall is fully leased. While many American malls are fighting declining shopper traffic, it shouldn't be a problem here. More than 15 million tourists are expected to visit this New York City neighborhood next year. Plus, there are 13 subway and train lines shuttling 300,000 commuters to the train station below every day. Westfield has infused many of its 34 shopping centers in major cities in the U.S. and the U.K. with technology, but Lowy says this World Trade Center location is by far the most state-of-the-art.
It's probably got the best backbone, fiber optic backbone, Wi-Fi, beacon system, camera systems, of course, immense focus on security. So this would probably be a blueprint for all of our future buildings in a digital infrastructure sense.
Westfield World Trade Center hopes to be a mall for the future that keeps a respectful eye on the past. For Nightly Business Report, I'm Courtney Reagan in New York City.
Coming up, an offshore project enters its final stage, and it's marking a big milestone for America's growing clean energy industry.
And finally tonight, there's been a big push to find new clean ways to power the planet, but it has been an uphill climb for a number of reasons, including high costs and regulations. But one of the solutions is taking shape now just off the coast of Rhode Island, and that's where Jackie DeAngelis is tonight.
It cost $300 million to build, but just 3 miles south of Block Island, construction of the first U.S. offshore wind farm is nearly complete. When operational in early fall, this 30-megawatt project will provide energy to roughly 17,000 homes. That covers the island and a little more. The project is the first of its kind in the United States, and estimates suggest that it will reduce consumer power costs here by roughly 30%. Important to this community, where energy costs are among the highest in the nation. Deepwater Wind, the company behind the construction of this 5-turbine wind farm, used private funds to construct it. It will receive a government subsidy in the form of a 30% tax credit.
The wind turbine under construction behind me is almost 600 feet tall, and it's about 3 miles off the southernmost point of Block Island. Now, why this project is so important is because people say it lays the blueprint for projects to come.
And Deepwater is using that blueprint to plan its next project, an offshore wind farm between Block Island and Martha's Vineyard that would generate 1,000 megawatts of power for Long Island.
I think in the next decade or so, we'll see several gigawatts of offshore wind built. The opportunity is much, much larger than that because we have an enormous offshore wind resource off the northeast coast.
The Department of Energy says nearly 16,000 megawatts of offshore wind projects are in various stages of development. Analysts think growth will be high in the coming 5 years. But these projects have their critics. Some unhappy homeowners say offshore wind farms are an eyesore that will hurt property values.
I think that's one of the huge concerns, that the property values could be a lot less now because you've got this structure, these structures you're looking at instead of a beautiful view of the ocean.
And while this brings down energy costs on the island, the rates that have been locked in are double what homes on the mainland pay. For Nightly Business Report, I'm Jackie DeAngelis in Block Island, Rhode Island.
We'll keep track of that one, see how that goes. It is. That does it for us on Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
And thanks for me as well. I'm Tyler Matheson. Have a great evening, everybody. We'll see you back here tomorrow.